Great to be here with you. That was a super interesting presentation from Brad Smith. We're here to talk about investment and growth, emerging markets, and just to jump right into it, Nick, you were involved in founding M-Pesa and Copa, which are two really interesting platforms that really transformed Africa payments. And through the mobile connectivity, you're looking at new investments in the region now. Can you talk a little bit about what the technology levers are that you're looking at you think are attractive for investing?
Yeah, sure. Well, those people who don't know what M-Pesa is now a digital finance platform that serves nearly 60 million people across Africa. And it's a great example of a technology solving for a real problem. The problem was, how do I move money between A and B? And way before we had smartphones or even Apple Pay or any of these other payment mechanisms, we built a platform to allow somebody who didn't have a bank account to move money between A and B over effectively what was a feature phone. And this thing filled an enormous gap in the market, and today 60 million people using it. Around the world, about 1.7 billion mobile registered accounts. So it's a big thing now, and that's taken 15 years to come through. It's a really important lever. So imagine the ability to move small amounts of money around between phones and between people or organizations that are not traditionally banked. I then co-founded a business called M-Copa, which was taking people in from non-consumption of energy. Great to hear what Brad was just talking about. We can design energy solutions that are distributed and work for small businesses and small households, and M-Copa started doing that using mobile payments to collect money and digital connectivity to watch what that equipment's doing and turn it on and turn it off. And today, M-Copa's got about 5 million customers financing assets such as smartphones and electric vehicles, and it's growing very fast. Because what you've done with those two levers, ability to move money around and the ability to connect a device, those are very powerful levers that we can use for lots of business models. And the thing I'm working on now is how do we use those two levers to get more access into carbon markets. So it's New York Climate Week. I expect many people in the room must be aware of that. The carbon markets, it's a beautiful concept. I need to buy credits to meet my net zero goal. You've got an excess supply of credits. Let's trade across the market. It's a beautiful economic concept that's very, very hard to make it work in practice until you bring in these new digital tools. So with the carbon value exchange, we're using data capture, using technology to watch that activity on the ground in sub-Saharan Africa. Could work in many emerging markets. And if I'm I'm a corporate buyer in the West of carbon credits, I can see my money go to projects where I've got real data that represent that carbon removal or reduction. So directly between buyers and sellers, using digital finance and using digital technology, we can make the markets work much more efficiently.
And you can direct that money right down to a micro level so that an individual who has control of some carbon.
So today we've got farmers using solar irrigation pumps on their farms in Kenya. They would have chosen a petrol pump because the petrol pump is still cheaper. But if you can bring a new revenue source to them for the carbon credit by displacing that petrol pump, and they're using a solar pump, then we can move money all the way down to the M-Pesa wallet of that smallholder farmer. And that's a game changer because you're suddenly putting a little bit more money into that person's pocket or their digital wallet. And the numbers are huge. I mean, literally hundreds of thousands of people that could benefit in sub-Saharan Africa and Asia from this type of technology. Small amount of money linked to the data. And for me, that's a really exciting opportunity. It's where we can take mobile or digital finance at the next stage.
Use technology to move things forward more rapidly.
That's it, yeah.
So Ervin, maybe if you could talk a little about, you're thinking about emerging market investing. You guys are a huge investor in emerging markets, and obviously everybody knows that you're probably your biggest emerging market investment was a long time ago, and China was an emerging market, and you guys ended up in Tencent. But you have a huge portfolio beyond that. And could you talk a little bit about how you identify opportunities in emerging markets and where you see opportunities and how technology plays into that?
Happy to do so, and it's great to be here. Let me just start with a little bit of intro on who we are, because notwithstanding the fact that some know us, some don't, we're not a company that seeks the limelight, but we are a business with a portfolio of $150 billion, most famously Tencent. We have a 25% roughly stake in Tencent, and that's these days call it 125 or so, and we have 30 billion of other stuff. So we do invest globally around the world. We have both investments in minority positions as well as operating businesses that we control and consolidate, and that set of businesses, roughly 6 billion of revenue, growing 20% plus. So we have operating businesses, we have investments, we're absolutely global, and our intent is to back the next class of disruptive innovators like Nick. If I had known Nick a little bit earlier, we would have backed M-Pesa.
We can still talk.
His new carbon offset thing, we can talk afterwards.
Yeah.
But the aspiration, of course, is to find opportunities where technology can genuinely disrupt a sleepy incumbent industry, whether that's in India, where we've deployed 7-8 billion of capital, or in South Africa, where we, of course, have a large presence in the form of Takealot. Some of you may be from South Africa and know Takealot. In Romania, where we are the majority owner of a business called eMag, which is an e-tail company. So around the world, Brazil, of course, some of you may know, we own iFood, which is one of the most successful food delivery platforms around the world. We look wherever that opportunity sits, and technology has to be the heart of the offering.
Are there technologies right now that you see that are particularly advantageous in emerging markets that maybe are going to turbocharge development of certain sectors? Or
I'd say the following. I think when looking at emerging markets and trying to access what are, we have to acknowledge, generally lower income tiers of consumers than you might find in developed markets, you have to be more flexible about what technology actually means. So what constitutes a full tech-first company in the US? Well, that definition you have to be more flexible about in India, for instance. So I'll give you an example. We recently invested, we're investing in a housing finance company, and this is a company which, you think of fintech businesses generally, you think of software and an app and a very digital interface. This is a company that actually has branches, physical branches. Because in India, the way banking gets done, the way consumers actually conduct their financial lives is often through physically visiting a branch. Yeah. So you have to be a little bit more flexible what the definition is of a tech-first business in an emerging market context. But the other part of it, as I alluded to earlier, lower income tiers, we are a big investor in a company called Meesho, M-E-E-S-H-O, which is by orders per day, the largest e-commerce marketplace in India, more than Amazon, more than Flipkart. And the reason they're able to do it is they sell lower priced goods sourced by sellers that heretofore, prior to joining the Meesho network, roughly 40-50% of them had never sold online. So this company is a play at accessing, we call it the next 300 million of Indians who are coming online for the first time, transacting, living the digital lives that many of us already live. Well, they're doing so through Meesho.
so what you're talking about, and Nick, what you do with M-Pesa, both of these, you're having to think a lot about people who have very limited income and trying to build a big business off of people who have small incomes is probably a different challenge than what the people in Silicon Valley spend their days thinking about. How does investing in emerging markets differ in terms of what you think about in terms of timeline, the horizon for an investment, in terms of scaling? You know, Silicon Valley, we talked about this before we got up here, that Silicon Valley thinks every company has to scale to the sky, and you know, maybe that's not the best way to make money if you're actually an investor, or the best way to build companies.
I think it's a great question, and to your point, it's easy to fall into that trap of thinking, just get big and profit will come later. That's that sort of old, sort of Western world's approach. But this point about no disposable income in the vast majority of, or very low disposable income in the vast majority of people, means you have to rethink that business model. Your product or service has to make a day-to-day difference to somebody. It's going to help them save a little bit of money or make a little bit of money. And if it doesn't, then it's just not going to scale, or you're not going to find a profitable business model. And it does take time, because you're stepping into an area where there's non-consumption, and you're trying to bring in a product that moves a consumer into consumption. By default, you don't know the business model. And it takes a while. You've got to pivot a little bit. I mean, with M-Pesa, we pivoted, goodness knows how many times before we said, okay, this is the answer. It's P2P. It's very simple. And then you can layer new services on top. The same thing with M-Copa. We started off doing pay-as-you-go solar energy, and we pivoted towards pay-as-you-go asset financing. I think you have to be flexible You have to take your time, and you've got to find that sweet spot that's helping that consumer make money or save money. And if you're not, you've got no hope of getting into that. You know, there's no disposable income or spare cash in people's wallets to make available to you as a business, and so it's a really important point.
I 100% agree with Nick. Look, providing a compelling offering at a lower price point to a lower income tier is only possible if you have the business model that also enables the supply side so that you can provide that offering. Exactly. For instance, again, I'm using Meesho as an example in India. On the logistics side, how do they get a good to a consumer? Consumer goes online and buys something. Meesho doesn't use the traditional, I'll call it larger scale couriers and delivery companies to provide the last mile logistics. They actually contract with, call it 3, 4, 5 person, we call in the US mom and pop style logistics firms who have excess capacity, and they cobble together a number of these. There are actually as many as 5, 6, 7 hops in getting a product from a seller to a consumer. That's highly unusual in a developed market, but it's what enables the company to actually provide that product for that lower price point.
Great.
So the business model has to work both on demand and of course on supply to enable that.
I think the West the developed world has a fairly risk-averse approach to a lot of emerging markets. It's, you know, I'm sure you've encountered this. People look at emerging markets and they think, you know, you have to compensate me a lot for the additional risk. Do you think that the developed world investors understand the risk? Do you think the risk that they assign to emerging markets is appropriate?
You should go first.
Yeah, I'll go first. Well, we've had a tough couple of years. You know, there's been a sort of correction in the valuation of fintechs. We've seen several big fintechs go to the wall in sub-Saharan Africa, and it's been hard. So you sort of understand that there's this risk premium layered into investments in Africa. But in my head, if we think rationally about it and think about a 20-year time frame, why the hell are we not investing in these emerging economies? If you look at the demographics, the population growth, the natural resources they've got available, you know, and here we are struggling with 2-3% GDP growth in Europe, and you know, maybe some countries doing better than others, but it's a hard place to look for growth opportunities, and yet you know, there are these opportunities in front of us in emerging economies to make long-term plays, but we do have to adjust our risk profile because it's, you know, it's tough. You know, it's almost the reverse of what we need. We need capital that's going to be willing to take a long-term bet, take the risk, because the prize is huge.
Let me answer it this way. Language is almost not our friend here because we use the term emerging markets for simplicity's sake. But not all emerging markets are created equal, right?
Yep.
There's a very different proposition investing in sub-Saharan Africa relative to India or relative to an Eastern European country which perhaps hasn't seen the limelight yet. It's still very different. What we would say is there are a set of parameters or conditions, of course, which we would want to see in any context. And that's to some degree, as much as possible, a stable political regime, a stable political landscape. Of course, the infrastructure, whether that's water or roads or electricity, power. My goodness, our friends from South Africa will know that power has been a problem in South Africa, and it can be a problem everywhere, Nigeria as well. So some of the basics have to be there to a sufficient degree that growth can emerge.
Yeah.
Thank you. We have to leave it there. I think, we believe it or not, we've used up our time.
Gosh.
But thank you very much for the insights. And